Welcome to our weekly market review. Now, last week, the IMF warned South Africa it's heading for a debt spiral, exactly what private sector economists have been warning about for years now. But this time around, there seems to almost be an urgency coming from National Treasury to put a lid on spending. Provincial departments have been instructed that no new spending will be allocated and some will have to prepare for budget cuts in 2024. So, simply put, National Treasury is not raking in the cash as it expected to do this year. Last week, July's budget balance print was the worst monthly shortfall ever recorded, a 143 billion rand deficit. July's credit demand, also out last week, was also weaker than expected as the impact of the higher interest rates start to show. Now, the thing is, South Africa has always managed to scrape by the skin of our teeth, but the wind has changed, most notably the drop in tax revenues linked to the pullback in commodity prices. The state has been pushed to implement fiscal consolidation and austerity, and this may keep the fiscus operational for now. But unless the government proves it has the political backbone to support this move by reforming policies into ones that promote growth, this fiscal consolidation will only serve as a band-aid on a gaping wound. As for the rand, the currency has started the week off on the front foot, capitalizing on the US dollar, drifting lower on Monday morning. It comes as all of last week's data prints out of the US pointed to a labor market losing some momentum, which adds to the disinflationary impulse in the US economy. There was a slight uptick in July's inflation figures, fueled by the Barbenheimer craze as well as concert tours and an equity market rally. However, unchanged rates remain priced in for September, with expectations for eventual rate cuts actually brought forward. Optimism out of China is also injecting some positive news into market sentiments. There are signs that the struggling property market has managed to turn a corner. Now, Chinese authorities have pulled various strings in recent weeks to inject some stimulus to gain some economic traction. And last week's dip in non-manufacturing data reflects the need for more stimulus. That's despite the slight improvement in the country's manufacturing PMI. And over in the EU, August's inflation data provided little direction on the central bank's upcoming decision. Despite losing some disinflationary momentum, both headline and core CPI is expected to resume their downward trend in September. But this data will only be available after the central bank's decision, which for now remains on a knife's edge. This week, we'll be tracking South Africa's Q2 GDP release out on Tuesday with a 0.3% expansion expected, so not much. Then on Thursday, consumer confidence for Q3 as well as Q2's current account balance will be published. Internationally, the US's non-manufacturing PMI for August will be out on Wednesday. Now, the services sector accounts for about 2/3 of the US economy, so the figure will be closely watched to gauge the risk of an upcoming recession. That then the week that was and the one to come for the markets.